Good afternoon, everyone. Welcome to another Wednesday webinar. It is Wednesday, June 12th, and the markets are an interesting place. We are starting to encounter some resistance, and we'll get to that in a second. My name is stockdarts. You can follow me on Twitter under the name stockdarts. You can follow me on YouTube under the name stockdarts, and you can also visit me at patreon.com/stockdarts, where I post extra content throughout the week, both the recording of these Wednesday webinars as well as some blog posts on the trading process, and some of my trade picks throughout the week and what I'm looking at, and sometimes even just like watch list types of stuff. Hi Denise, glad to see you in here. Glad to see Wes, Ron, you guys as well, and anyone else that's coming in. Good to have you guys in here. Now, we're going to do the usual. We're going to look at the S&P 500. We're going to look at the NASDAQ Composite, the Dow Jones, and the Russell 2000. Once we conclude that, we'll take a quick look at the US dollar, see how it's behaving, see how it's affecting gold and silver, and we'll take a quick look at oil. And once we do that, then we will move on to the chart request portion of the show, where I'll take a look at any charts you guys are looking at and give you my thoughts on it, on whether it's coming up into resistance or support or anything along that nature. If you guys have any requests, you can start putting them in now, just so I get an idea of what it is you're looking for and how much time we need to allot to it. Feel free to let me know if it's a name that you're trading, if you just got into it, or if it's a name that you are looking to enter and you're not really sure where to go ahead and pick your entry spots or exits or anything of that nature. And I'll go ahead and try to give you the most pertinent advice I can. Other than that, let's go ahead and get started. We're going to take a look at the S&P 500 first, and you can see we've spent the last couple of days and basically this week printing red candles as we bumped up into resistance. We had a really strong move as of last Tuesday or so. We discussed this during last Wednesday's webinar, the fact that it looked like we were breaking through some key levels on some of the indices, and there was a chance that we would continue higher. Now, I expected us to probably spend a little bit of time consolidating before we kept climbing, but we just sort of climbed higher the whole way. And just, you can see it clearly on the S&P 500 on this chart of SPY, where the first day, I believe this was last Wednesday, breaking through these critical levels, this red line, the dotted price line that I pointed out. Then the next day we cleared the 20, the next day we cleared the 50, and then on Monday we started bumping up into some serious resistance, which I mentioned was going to be a likely spot where we would eventually climb up to, but probably not surpass, at least not on the first go. And so far that played out. You can see yesterday we attempted to move higher, and we sold off pretty much the whole day. And today we opened up lower, and we've just been hanging on for dear life and trying to stop from continuing this downward action off of these highs. Now, we're kind of at a spot here where we could do one of two things, right? We can continue to head lower, maybe lose the 50-pair moving average, and start to probe down back to the 20 and retrace some of this move that we had, or we can just print a bull flag and sort of stabilize and hold here. Now, if you just look at the price action on the S&P 500, I would say it favors the formation of a bull flag. Typically, when you have this kind of move upwards, right, where you start to just kind of break through different levels, you have enough upward momentum where once we start to see some selling, you're going to have buyers step in again. They've been convinced that we're back into a bull rally mode, and we're back into a buying mode. And so what ends up happening is when you have traders taking profits during that time, you get a lot of buyers to step in right away. So I would say it favors a bull flag, but going through and scanning through a bunch of different names and looking at all the charts that I like to look at when I'm looking for swing trades, I've seen a lot of tired names and a lot of names that are starting some selling patterns. So there is that we just kind of fade back here and pull back further and further back, maybe to the 20-pair moving average, at which point, again, I think that we flipped the switch here. This selling pressure that we saw that began sort of in the middle of April and came all the way through May, I think that we found a short-term buy and an intermediate-term. And I think at this point, back into what I've been kind of pointing out and what I've been saying for a while now, which is that we need to spend some time trading in this area here. And we've done that actually already for quite a bit of time. For those of you that are regulars, you know I've been pointing this out for a while. That I think that the scenario that's more likely during the summer is that we spend a bit of time kind of trading in the upper half of this bigger range that we spent the last few years, right? And for the moment that has played out, it may not continue that way, but for now that's what's playing out. And if so, then it's going to mirror a lot what we saw back in 2015 through 2017, which we'll zoom out a bit and take a look at, which again was the same thing, right? We had what started off as a strong rally that eventually rolled over, and then it looked like we might top out. We bounced, we came right back down, and then even the new lows looking like we were going to roll over again, like we did top out for real. And then what happened? We came right back up to the top of the range, and you notice at that point we spent a good few months trading below it, but on the upper half of the overall range, and then eventually we broke out. And we're almost doing the same exact thing. We rallied up again, then we came back and retested the lows, came back up and tested highs, came back down, printed new lows, and really threatened a rollover, and then kind of came right back up and tested the highs. And now what are we doing? Well, we're testing and we're printing sort of an idea of kind of holding and consolidating below the highs, but not coming down to test new lows. And continue along this pattern, well, then the next step would be to establish price action above this range and then hold it. At which point then we could maybe look at a new rally. Now, we're getting a little bit ahead of ourselves. I don't know that we spent enough time trading sideways to really have enough momentum to break forward, but that's the scenario that's playing out right now. If we want to go ahead and look and say whether history is repeating or rhyming right now, we're in a very similar price action to what we saw the last time we had a major broad range consolidation, and I think that we still have a bit more time to really conclude broad range consolidation that we've been doing. But if we hold around these levels for the next month or so, then I think it bodes well for a breakout and a move higher. Now, there's always the possibility that we're not ready, right? And I think now we have a couple of clear lines in the sand, right? If we start to move lower and we start to break and breach these lows from last week, well then there's a pretty good chance that means we need to head back down and test the bottom of this range, which means that the scenario I just played out would be sort of invalidated and we wouldn't really have to pay attention to it any further. But as long as we stay above that, I think more likely if we stay above 280 or so, then I think that we're setting up for a move to come back up and push past these highs and start to print new all-time highs on the S&P 500. Now again, we're going to take a look at the four major indices and see if all of them are sort of corroborating this story and are printing the same sort of action. Obviously, IWM is going to be in a little bit of a different place, but we'll see how all four of them are behaving and whether we have consistent behavior across the board, which of course is one of the key factors in figuring out what's going on in the markets. When they're behaving differently, that's when we know that we're going to get a lot more range-bound action, a lot more back and forth, which is what we've seen for the last month or so. Now, if we continue to trade sideways, then it just matters. The real big thing is how we're going to go ahead and set up for a bounce. Now, if we print the bull flag, then we shouldn't lose price action below it. I'd say about the 50-period moving average. Matter of fact, around today's lows are a little bit below there. You'll notice if we zoom in, there's a couple times that we've closed around these prices. Now, this isn't a major price level. This isn't something that I could say has any real sort of strong significance, but it's a spot that we could look at as far as where we'd want to hold if we want to print a bull flag instead of retracing more of this move, right? And again, the 50-period moving average is slowly climbing up into that price range. And I think as long as we stay above the 50, then what's happening is we're just printing a bull flag, which means that we are likely going to attempt to push to new highs and start to break past that. Now, if we start to fall below the 50, then I think there's a very good chance we're going to come all the way back down to the 20 period, at which point what we're looking at instead is a scenario where we are trying to confirm this breakout here, this candle, and this breakout of a critical area, which we saw last week, which is this 280 areas. We broke this descending trend line, and we broke the dotted line, which was a key support slash resistance area. And so there's two scenarios I think in play right now, which is either we hold at the 50 and then really try to break out, or we sort of meander right back down to this area, at which point we need to kind of confirm that we're holding above 280, and then we just slowly build up pressure as we start to make our way back up. Now, I think the more likely scenario at the moment is probably the bull flag. And I think we'll get a better gauge of that today in the afternoon, depending on whether we print new lows on the day or whether we kind of hold here. If we go to a 5-minute chart and take a look at what we've been doing on the S&P 500, and you can see we opened up and we've just been trailing down the entire day and printing new lows, and we have yet to really break this downtrend. If we continue to print new lows, then I think that it's probably hinting at the fact that we need to continue lower, at which point maybe the bull flag is not in play. But I think we've also held pretty strongly despite the fact that we've been trending downward. So once we breach that and we start to rally, and if we do rally into the afternoon, then I think, again, what it shows is that we're printing a bull flag. And then from there we could take a look at how it's behaving, and we can start trying to figure out what kind of charts we want to look at, as far as looking at our swing trades and where to go from there. I will point out one thing. For those of you that are Patreon members, I did recommend shorts, or short play and a long play on Monday. And the short play worked out better than the long play. And the one thing I'd want to say right now is whether you're going long or short, you probably want to have a pretty quick trigger finger, and make sure that you don't let yourself get chopped around, because I think right now, even though there's still probably some lingering upward bias based off of what we've seen the last week or so, we're starting to encounter some selling pressure, and we are at resistance, so there's decent possibility for downward action. But because there's still some of that lingering upward bias, even if we do get drops, there will be buyers that sort of step in and muck up trades to the short side, and trades to the long side are encountering resistance, which means they might have some issues as well. So the big key right now is whichever side you decide to, whatever trades you're picking, make sure you're quick as far as taking profits or locking in profits, because more likely than not, we're going to continue to sort of chop around here over the next week or two as we try to figure out where we want to go next in the overall markets. Now, the key levels that we need to concern ourselves with, I know we've already kind of hashed them out, but basically resistance is 291.80, basically just below 290. Now, if we break that, obviously all-time highs at around 295 are the next step. But I think that the ceiling from last year is still sort of in play, and I think that was right around where I expected resistance to come in, which is exactly what happened over the last couple of days. And then the 280 level is the other key level. I think those are the two major levels we need to watch. I think those are the ones that are going to sort of hold or kind of contain price action for the next week or two. And those are the levels I'm watching. If we breach them to either side, then I think the story changes, and we have to figure out what the next scenario is and the next idea. Now, again, if we breach to the upside, then what we want to see is we want to see us hold above that, at which point maybe we're ready to continue to start a new rally and see where we go from there. If we break down below 280, well, then we have to start exploring the idea that maybe we need to head down and test a lower portion of this. But of course, we still have a couple lines in the sand before we worry about that, which would be the 200-period moving average around 277, and then last week's lows around 273. And as long as we hold above those, I think we're still playing out in that scenario where we're just holding the upper half of this range. And if we lose that, then I think all bets are off, and we have to figure out what the new market environment is and see where we are in the summer. Now, if we look at the NASDAQ, it's very similar to what we're seeing in the S&P 500. We didn't quite reach the ceiling of our price action around 187 or so. You can see that we started to falter right around the 50, and we're actually trading below the 50-period moving average. Now, some of this is due to weakness in Facebook and weakness in a lot of these FANG names are still showing some weakness. If you take a look at Facebook today, you can see that it had a stronger retracement off of some bad news. Apple is actually holding up well, which I believe, Denise, you're the one that was looking at it the last few days, and I actually recommended this in my Patreon page as well as a possible long trade a couple of weeks ago, and it's actually worked out really nicely. Right off of that support level we were watching, it did have a sort of a false breakdown below it, but once we were able to sort of break this downtrend, it's had a real nice climb. And I think of the FANG stocks, this one's holding up the best right now, which is a nice turn of events compared to where it was before. But I think Facebook at the moment is the weakest. Google was also having a little bit of trouble. And overall, you can see that the weakness we're seeing here is having a strong impact on the NASDAQ, or on the Qs, as far as it's not being able to reach the same relative points as the S&P 500. And again, you can see the NASDAQ below this 185, 186, 187 area, which is kind of critical. Now, a lot of the same reference points still are playing out, right? As long as we hold above this 178, then I think we're still testing the same thing, this sort of upper range. You can see, again, very similar to the S&P 500, what we're really doing is testing the upper half of this broader range that we've spent the last couple of years in. So it's the same sort of key reference points. If we lose this 178, which was the break of the descending trend line and our most recent sort of downtrend, then we come down and test the 200-period moving average, and then as long as we don't breach these lows from last, I think this was actually 2 weeks ago, around 170, then we're still maintaining the price action in the upper half. Now, to the upside, if we can rally, well, we need to break 187 in order to start challenging all-time highs around the 192 area. But again, I expect this 187 to be pretty strong resistance. I don't think we're really ready to sort of print new highs and to start making a new rally across the board. So I would expect us again to sort of be contained between these two sort of endpoints, one being about 187 and the other hopefully about 178. And as long as we stay in between those, we can just sort of continue to build up pressure and find new buyers that are willing to step in, and then see if we could challenge new highs once we have a nice exchange and we have, you know, the old buyers sort of take profits and we have new buyers stepping in willing to try to push the price action higher. Other than that, I would say right now the tech names are starting to sort of lag a little bit, which is fine. It's just regular price rotation, and we just need to figure out where money's rotating to and what areas are starting to pick up some strength. If these names need longer to pause. Now, again, we're starting to see Apple was gaining some strength recently, and there is a chance that we could see some strength flow into some of the other names, and maybe then the Qs could sort of regain some of that relative strength that they started to lose recently. But until then, we can just sort of watch and see what happens and try to figure out where money's rotating to as we range sideways. A big key when you're in a range-bound market is trying to figure out where the money's flowing to. A lot of times, if you're chopping sideways, there's going to be areas that are doing well, and there's going to be areas that are going to do poor, while the market just sort of doesn't go anywhere. And I think that's one of the real keys to learning how to trade in these sorts of environments. Now, if you're having trouble understanding how to trade in these types of environments, and you want some advice, you can always ask me. For those, I'm sure most of you guys are well aware of this already, but I do offer mentoring one-on-one. It could be on a session-by-session basis. I know most of you guys are pretty experienced traders, but if you feel like you're having trouble with a certain facet of your trading or a certain area, feel free to ask me. I'm more than willing to help, and I'm more than willing to try to figure out a way to help you guys improve on your trading. It could be just a 1 or 2 session thing where we work on something like understanding what environment you're in. It could be something where we want to work on developing more options plays, learning how to structure certain types of plays, or it could even be one of these things where you just need some psychological help. For those of you, maybe you're not aware of this, but my majors in college were psychology and philosophy. I've done some counseling in my past, so I'm more than capable of helping people in working out the psychological aspects of trading as well. Now, if we look at the Dow Jones, you'll notice, again, very similar to NASDAQ, and actually it's kind of interesting. This is right in the sort of a blend between what we're seeing on the Qs and what we're seeing on the S&P 500. We're relatively speaking pretty weak. We haven't hit anywhere near our our highs. We have yet to actually push to new all-time highs like we did on the S&P 500 and the Nasdaq earlier, but we're actually holding above the 50. So we're relatively speaking a little bit stronger than the Nasdaq in the short term, but in the long term or intermediate term, we're still kind of off of our highs. We are, however, in the same sort of state where we are hovering above the upper half of our broader range. We are confirming this breakout of this short-term descending trend line. We're holding above our key level here around 254 to 255. And, you know, the question here is, where are we going to find some more resistance? I think at the moment, the next level to really test is up here around the 264 to 266 range before we try to push to new all-time highs. And I'm not going to really leave that trend line there, but just to give you an idea of what we can expect as far as our upper ceiling in the short term. Now, again, we should not lose this area here. You can see there's a lot of potential support here. We've got the 20 period. We've got this price range around 255. We've got the 200 period moving average. If we lose all that, then we're likely to come back down and test the lows from a couple of weeks ago, at which point, again, it means that a test back to the bottom of the range is in the cards and something that we need to really worry about. Now, again, I don't think that's what I'm concerned with at the moment. I think at the moment, I really think that we're just going to stay range bound and we're going to trade somewhere between 255 and probably about 265. And it's up to us again to figure out where the money's flowing while we stay range bound in that area. Now, if we pull back and sort of, and interestingly enough, by the way, you'll notice yesterday's candle has this really long wick. I think that was just sort of a misfire or misprice. We didn't really trade all the way down to 257. And we did it. If that was a real trade, it was just one trade or a few. But the real floor for yesterday was really around 260. And that would be kind of where we can expect now. If we do start to fall backwards, I would expect us to come back down and maybe test the 20. But as long as we stay above this glut of support, we should be fine to continue trying to stay range bound and sort of fill out this area here a little bit more. There's really not much more else I need to say about the Dow Jones. It's almost the same story as the Qs and the S&P 500, and really nothing is different as far as understanding the key levels and the reference points. And you'll notice a lot of times when you look at random charts, they're going to have the same sort of reference points. They're going to be doing the same sort of thing, and it's up to you to figure out whether they are ahead of the curve or behind the curve as far as following what the markets are doing. Now, the last one, of course, is IWM. And you'll notice IWM is in a totally different place, right? Look at our ceiling and our highs, 173, nowhere near there. Really just trying to stave off a total failure here and a breakdown below and to new lows. We continue to really lag behind. Now, in the last couple of days, relatively speaking, we've held up a little bit during the daytime. If you look at, we're looking at the 5-minute or 30-minute chart of your day trader, the small caps have done a little bit better job of holding lows and trying to bounce, but that's really just something that's contained towards the really short-term time frames. In the intermediate to long term, they're still, relatively speaking, the weakest of the four indices. And overall, still the place you want to look at if you're still trying to find more bearish trades, if you still don't believe that the market's ready to rally and you want to continue to sort of hammer the downside, then I think probably small caps are the place to look until things change, right? And the only way that's going to change right now is if we get above 158 or so and start exploring the upper half of that range. You look at the other three indices were trading at the upper half, and IWM is still trading not only at the lower half, but the lower quarter of our recent 2-year range. So still a lot weaker and needs to play a lot of catch up in order to sort of be in the same place as the other three indices. Now, normally you look at this and say, well, if the small caps are behaving like this, there's no way we could rally across the board. And that's been one of the reasons that I've considered the last few years to be more of a broad trading range rather than a strong continuation of the rally we had back in 2017. But that being said, we have rallied in the past before without IWM really consenting and just sort of sullenly following behind. But if we can't get the small caps back above these major moving averages and starting to climb upwards, then I think again it tells us more likely than not what's going to happen is we're going to be range bound across the board until we get better behavior out of these guys. Now again, it is possible that we rally without them and IWM just sort of follows along, but even in that scenario, I'd expect a little bit more strength out of IWM than what we're seeing. So for now, I think this is kind of like the canary in the coal mine telling us that we're not really ready to break out yet. And until we see a little bit different behavior, we can expect the price action to be mixed and to find a lot of false signals across the board because there's a significant chunk of the market that's not really ready to rally yet. Now, what do we need to see in order to change that? Well, the first step, of course, is we need to break the 200 and the 50-period moving average. You'll notice the other three indices, for the most part, had cleared them. I know that the Qs had not really broken the 50, but they were all holding above the 200. They're all above the 20. And IWM is barely holding above the 20. They're below the 200 period. They're below the 50 period. First scenario, we need to get above 153, 154. The next scenario, we need to break 158. And I think that's going to be the real key. And I think if IWM can break that, then we're going to see the rest of the indices break to new highs and probably new all-time highs. But that's, again, I think quite a bit away still. But I think that's the big key here is to break 158. If we could break 158, you're likely going to be seeing new all-time highs in the S&P 500 and the NASDAQ, and possibly even the Dow. But until then, we'll just have to wait and see what happens. And if IWM continues to sort of meander around these levels, then we need to be real careful that it doesn't breach 145.60, really 145. If it breaks down below 145, there's a pretty good chance the other indices are going to have to come back down and explore the lower half of the 2-year range we've been in, at which point I think we're in a different scenario than the one I'm outlining right now. And to be clear, what I'm saying right now is that in the intermediate term, I think we're still in a broad range consolidation, trading sideways, chopping around, and we need to get a little bit more time to digest these price levels before we could resume our long-term uptrend. And in the short term, again, we're just kind of bouncing into resistance. All right, so that's the 4 major markets. If you have any questions, feel free to ask. I think I've been pretty clear on what I expect in the next couple of weeks, but it's the market, and it can do whatever it wants to do, right? But I think for the most part, we're range bound, and we should be approaching our trading along the same point and looking for plays that are looking to either bounce at support or hit into resistance, at which point we can either sell premium or even go ahead and short. I'm not sticking to too many breakouts at the moment. I think if you're looking to trade breakouts, maybe if we set up a bull flag over the next few days and then try to break to new highs, at that point maybe some breakout plays will work. But for now, that's not what I'm looking at. I'm looking at either plays that are emerging from consolidation ranges or at support. Now, let's take a quick look at the U.S. dollar. Nice day today, but overall, you can see we're losing this channel we've been in. And I think overall the U.S. dollar has started to show some weakness, which has really started to show itself in gold and silver. Now, the UUP index as an aggregate is attempting to rally here and trying to get back into this channel. If it does so, then that's a temporary win. But overall, I think we're seeing a lot of damage being done to the U.S. dollar. And part of it's probably raised to the fact that they're actually hinting at lowering rates again. And if that's the case, then we'll see us lose this channel, come back down, test 26, and then maybe even come back down and start to explore way back down here on the 200-period moving average. Now, if we look at the Euro-US dollar cross, the Euro finally confirmed a strong breakout of this bearish trend that it had been in for the majority of 2019. Matter of fact, you can see at the very beginning of the year, we tried to push past 115, failed, and we've been trending downwards this entire time. We finally had a break and sort of a bottoming out around this 111 area, and then the major break around 112, which got the euro to finally break this persistent downtrend. Now we're climbing higher. I still think 113 and then 115 are going to be serious ceilings for price action. So there's a chance here, and you can see again the euro's pretty sort of a bull flag here, so it still has some upward. It's still trying to build some upward momentum to continue up higher. And again, this is going to be a mirror of what we're seeing on the UUP index, right? You'll notice the UUP index had an ascending channel. This one has a descending channel because it's inverse is priced on the euro. And we had that breakdown, and then we're just waiting for a rally back up to about 111 or so on the US dollar. If the US dollar were to bounce, at which point the euro would kind of come back down. But that's not what I'm seeing right here in the euro. The euro is holding up strong. And even though we have a down day today, it's trying to print a bull flag, at which point it might try to make its way back up. So overall, I would say this is a pretty nice move out of the euro to sort of really show that it's bottomed out. I think it's still typically when you see this, when you have a strong trend down and you finally break it, it doesn't mean that you go from downtrend to uptrend. It basically means you went from downtrend to neutral trend. So I expect a lot of selling pressure on the euro as we start to approach some of these levels just overhead, such as 113 to 114, and then even more importantly around 115. So at this point, we probably expect it to stall out, which will give the dollar a sort of a little bit of a relief bounce at these levels. Now, if we look at the U.S. Canadian, you'll see same thing where we had the Canadian, and again, so this was priced in U.S. dollars, so up is good for the U.S., down is good for the Canadian. And you'll see the Canadian finally gained some strength versus the U.S. dollar. We had a pretty big breakdown through a key level around 133, and then even below, so between 133.80 and then between 133, and we finally found a little bit of support at the 200-pair moving average, and we've had this little relief bounce, very similar to what we're seeing in the UUP index. But overall, this is a major breach for the U.S. dollar versus the Canadian, and it needs to kind of come back up above this level. Otherwise, we are again showing a pretty bearish move here, losing a pretty key level of support. And again, this goes all the way back to this inverse head and shoulders, and then this little area of consolidation. So we had this triangle, and if we lose that, then there's likely more downside. So we need to kind of reclaim that and at least sort of hold up above 133 if we want to see the U.S. dollar sort of hang on for dear life against the Canadian. And then finally we have the U.S. versus the and again, we had a breakdown. We had the little relief bounce. It was a nice little 3-day pattern here that we were looking at, but it really hasn't done much since then. You'll notice the wicks, again, flipped to the upside, showing a lot of selling pressure here as we hit 108. And it's having a lot of trouble trying to climb through here, and is actually nowhere near this 109, which should be significant resistance. So the U.S. yen is also really starting to struggle here, despite this temporary relief bounce. So all three pictures, I think, are showing the U.S. dollar starting to lose a lot of the strength that it's had. And while we are seeing relief bounces, and there's a chance that the U.S. dollar can rally for a few more days, I think overall we've seen a big shift in character, where the U.S. dollar has now downshifted to neutral at the very least, and possibly bearish, depending on how we continue to behave into the next few days, or actually next few weeks. So with that said, you'll notice the strength in gold and silver. Big rally out of GLD, a huge move, and then it's still pretty sloppy. This happens a lot with GLD because it trades overnight. A lot of sloppy action here, but you'll notice that we kind of came back down and we bounced up today, and we're just sort of ranging in this really broad sort of flag. But I'd say overall it's looking strong. And if we see another big move down on the U.S. dollar, we might finally see new highs on GLD, which we haven't seen since back in February. Right? Well, I mean, I guess we printed it recently. But I'm saying to breach these levels. And it could happen if we see more weakness out of the U.S. dollar. Now, it's hard to trade this right now because, again, it's very sloppy. But there are some nice gold miner names that are doing pretty decently. We take a look at KL, which Ray, you're in here. You were one of the first ones that brought this to my attention way back here when it was trading around this range. And you can see KL is doing very well and new highs. One that's a little bit of a different place is Kinross. Well, it's a KGC. Yeah, KGC. But very similar price action here where we had a break of a downtrend. We had the nice little 2-day tweezers, and then today we've had a nice gap up higher. And just across the board, if you look at gold miners, they're actually behaving pretty decently compared to what we're seeing in the markets in general, right? So this is an area we could continue to watch and could help us sort of weather the storm and the markets start to pull back a little bit further. But overall, the gold miners are looking pretty nice. Now, the trading patterns are a little difficult at the moment because we've already had a bit of a bounce, but it's something to put on our watch list and keep an eye on if the U.S. dollar weakness persists. Now, you look at SLV, it bounced, but it's still much weaker, relatively speaking, compared to GLD. And so I think overall, I'm still looking and focusing on gold names rather than silver. I think at the moment, silver's still very weak. It still hasn't breached a very critical level of resistance around 14 and is really struggling. So I would still focus on GLD until we see a change in character and we see SLV sort of try to catch up to gold. But at the moment, that's not really happening. And then finally, we have oil. Now, oil's in a very different place altogether. It's going off of its own thing. It's not really trading it inversely to the U.S. dollar. And you can see we're, for the most part, right back into this range. And we tried to break through it and failed. It kind of came back down. So at the moment, we can basically trade under the assumption that oil is back and range bound between 55 and about 40, 42, 43. If that's the case, might try again back up to 55, at which point, if it fails there, then it will continue to sort of do something like this. And then see what happens next, right? So this is a pattern we can watch and see what happens on oil. If it breaches to the downside, it's probably going to head down to about the middle of this range, somewhere around 48 to 47. If it can bounce and get back above 55, well, then we can expect it to make its way back up to about 57, 58. But for now, we have to assume that 55 is going to be the ceiling for oil in the near future, as it has now basically established itself back in this broad range, which again you can see on the weekly chart a little bit more clearly. This broad range that it's spent a good majority of the last several years in. It has gone back and forth above it and below it, but it's spent a very good portion of it in there, and it looks like it's back into that range. So for now, we have to maybe be a little bit more cautious with oil names and see what happens with that. Might want to look at some names that benefit from lower oil prices, like airlines, and see how they're behaving. Frankly, some of the charts didn't look that great to me, but a couple did look okay. But, just another way of thinking, when you see stuff like this, some of you guys might wonder, why do I always look at oil? Why do I look at gold and silver instead of just looking at more stocks? Well, sometimes getting a good picture of what's going on overall could give you better trade ideas of where to go and where not to go. If you see oil starting to lag, you can look at different names or different areas of the markets that benefit from lower energy costs, right? And so it could spur different types of thought into finding better trade ideas, right? So that's one of the big reasons why we do this sort of thing. Is I want you guys to take this information and apply it to what your specialties are, and see if you could find better trade ideas based off of these larger patterns that we're seeing in the broader markets. All right, so that covers oil, gold, and silver. We can move on to the charts now. Denise, you have one. AMGN. Anyone else? If you have any, I'd love to see what you guys are looking at. Wes, I'd love to see what you're trading. Lana, if you have any questions or any thoughts, feel free to ask. And same with you guys, Scott, Ron, Ray. Always willing to see what you guys are trading. I want to make sure that I give you guys as much information as I can, as much value as I can out of this incredibly expensive free webinar. All right, so here's AMGN. So long term, we're all right. So here's a look at the long-term chart, right? And I know we went over this a while ago. I don't remember if it was for you, Denise, or someone else. It was you. Okay, so you have covered calls, and you're in a long-term holding position here, and I think it's pretty clear what we're doing here, right? You have either you have or you should be covering calls or setting some covered calls around 180. And then around 190, and then eventually above, right? So you can see, again, major floor around 170. It used to be resistance. Tried a few times to break past it. You can see it slowly built up until it finally transitioned to where 170 was the floor. And then we had that nice rally. Then we had this broad range between 180 and 200, which we lost recently, and are back down to this 170 area, which should act as a floor, and it has at the moment. Now, we had the nice double bottom, right? We broke past it, confirmed the double bottom, and typically in this sort of scenario, and again, I'm not a big fan of measured moves, but just to give you an idea, what most people look for is you get the depth of that and you put it above it, and that's about what you should expect as far as a move off of that, which would put us right in line to about 180, which is where the real level is going to be now for us as far as short to intermediate term resistance. Let me delete these trend lines and then I'll look at your question. All right, so which would I say is more reliable support level, the 50-day or the 200-day? Oh, Ron. Okay, we'll get to that in a second, Ron. But the short answer to that, Ron, is always the longer term. The longer term support is usually the more reliable support. But we'll get into that in a second. That's a good question. Okay. All right. So Denise, as you can see, we found a little bit of a double bottom, a little bit below 170, but we held around that price range and we broke back upwards. I think 180 is going to be a pretty strong level of resistance. Now, I think we do break it eventually and make our way back up to 190. So I'm not sure how much of your position you want to use covered calls on, or if you even have covered calls at the moment. You say you have covered calls, or you're using covered calls. But if you have any covered calls, I'd say 180 is a good spot for some shorter term ones. And then once we could break 180, you can start looking at this descending trend line as the next stage. And then if we can ever break past that, then you can start looking at maybe the 205 to 210 area as your next one. But for now, yeah, you just play these broad ranges that we've just been looking at, right? You can see clearly 180 is one level, and I think 170 is the nice floor, maybe a little bit below it based off of the price action we've seen in May. But overall right now, if that double bottom holds, we shouldn't see the price action fall back below about 172 to 173. And so what we should be seeing now is just somewhere in this 174 to about 180. Once we get to 180, we should see price rejected. And what we want to see is when it does get rejected, that it doesn't fall back below 173. And then it could try to build up steam for the next move, at which point maybe you hold off on the covered call and you wait for the next move closer to 190, at which point you could try it again. Okay? All right, Wes. Intel, potential cup and handle. Yeah. Let's take a look. Let's take a look at the longer term. Actually, I should have just done a weekly chart. That'd be much easier. All right, so here's Intel in the longer term, right? We're at a pretty important level here. There's a nice floor here. We're going to copy this trend line. All right, so broadly speaking, we've got 42, 47, and then maybe $50 or so, right? As some key levels of price action, right? So we'll just draw these three horizontal lines just to get an idea, a gauge at where we are and what we can think or explore with Intel. Now, I would say, I mean, this is basically, yeah, you could call it a cup and handle. And what we want to see now is the handle fully flesh out. And then if we get a breakout of that handle, then we can expect to move up to this gap, fill the gap, hit the 200 period, and then maybe make our way closer to $50. At which point then we need to see what the next step is. This has been a pretty big change in character in Intel, right? We had this strong move up, and then we had this big gap down. We had another runaway gap down. Then we even had another gap down until we finally bottomed out here in the low 40s. So it's going to be hard to expect Intel to just kind of climb right back up. And typically, a lot of times, these cup and handles, what they really are is you have a base, right? You have a nice range of consolidation. Then you have a breakout, and then you have a bull flag, depending on the time frame, right? That's typically what a cup and handle is you just have a rounded bottom, which is just a consolidation range, and then you have a breakout, which is followed by a bull flag, which is the handle, right? And so right now we're printing that bull flag / handle, and if we can break that, then I can expect another move up to about 50, but I don't really expect us to push past that because this is major. This is a major downturn and a big shift in character, and I don't think that this base or the sort of the bottom of the cup and handle is broad enough to really give us enough significance to overcome this gigantic shift in downward pressure. When you have a move all the way from 60 down to 40, which is again a pretty significant move on Intel, you're not going to usually overcome all of that with just a 1 month sort of base. You're going to need a lot more time. You'll notice the last time we had a move back from about 58 all the way back down, it took a good amount of sideways price action. Again, this is going from November all the way to February before it was finally starting, being able to start climbing higher. And if you really think about it, it really spent from July to February trading in a range, right? So at the moment, I don't know that this is significant enough to overcome all of this. But if you're looking for a shorter term move, I think that this is enough to mandate a move up to here, or to warrant a move up to here. And then from there, we see what happens. And what it needs to do from there, right? Once it starts to hit the 200, once it starts to fill this gap, and then start to hit this $49 to $50 range, which is a kind of a critical price point on Intel in the long term. So that would be my expectation right now, is that it's going to probably continue to print sort of a flag here. Once it tries to break past that, we can see a move back up to 50 or so. But I don't expect more than that, probably until the next earnings cycle or the next earnings report, at which point it'll have enough momentum to either start to overcome some of this or resume towards the lows. All right, Ron, so you have a pretty good question, and you're asking me which would you say is more reliable support level, the 50-day or the 200-day? I'm assuming you're talking about the moving averages, but the key point to this, or the answer to this really, which I already said, of course, is the longer term. The longer the time frame, the more reliable it is. That's always going to be the case for everything, whether it's a trend line, whether it's an actual trend, whether it's whether you're looking at a chart. Again, the weekly, any pattern you see on a weekly time frame is going to be more reliable than any pattern you see on a daily time frame, which is going to be more reliable than anything you see on a 5-minute time frame, which is going to be more reliable than anything you see on a 1-minute time frame. The shorter the time frame, the more unreliable the move, because it's more and more dependent on price fluctuation and supply and demand. And the longer you get, the more it is to be based off of longer term price points, based off of more on fundamentals, and just in general on the longer term momentum that builds up through time. So typically the shorter time frame, so the 20 period is going to be the less reliable. The 50 is going to be a little bit more reliable than the 20. The 200 is going to be even more reliable. As far as key levels now, does that mean that when you hit the 200, you're supposed to stop because it's the longer term support level? No. More often than not, it doesn't. You can see on Intel, it actually gapped right through it. But if we go back to, say, the SPY, and you take a look at what happens, you'll notice a lot of times what happens with these moving averages is you'll kind of overshoot them. And you can see it clearly with the 200 period in particular, where you'll overshoot it and then kind of bounce back. Just the same thing we did there, which again, we even did to the upside. If you look at it that way, you can see again, we overshot it, right? So the moving averages in themselves don't necessarily mean that its price is going to stop right at the moving average. What a moving average does is it gives you it's the average, right? But it gives you an idea of what the overall sentiment and price action is, right? So sometimes when you look at it, what you're really looking at is you can see the moving average is sideways, right? So it's reliably telling us that price action is sideways. And it's going to be the same thing with trend lines. The longer term the trend line, the more likely it is to hold in the long term. In the short term, we could still get some breaches back and forth, but if you're looking for price levels and you're trying to figure out where a key price point is, the more times that price point has been relevant, the more likely it's going to continue to be relevant. So if I take a look at what's happened in the short term here, and I say, well, this was a pretty good price point. Well, this is not nearly as reliable as this dotted line, which was kind of a key price point throughout the last year, or even 290, which has been in the long term a lot more significant than something like this, right? So in general, the longer term, the more likely it is to help you, to basically be reliable and to behave in the way it's supposed to behave. All right, I got time for another one. If you guys have another chart you're looking at, Wes, Ford. I was actually looking at Ford recently. I wanted to show this. So your question, thoughts on consolidation just under $10? So my thoughts on the consolidation is this is exactly what I was looking at, and I think that this is, you actually pick a very important price point here. It's kind of a range. I'm not gonna, right? If that's $10, but it's, we look at, I guess, like from here, right? I was looking at this as a potential bearish play, but it's a play that can go in either direction. This is one of those coin flips. You can see long term, Ford has actually been pretty bad, right? Since 2015, 2014, it's just been steadily trending downwards, almost to a T every time in this channel. Now it does again breach back and forth through this, and a lot of people will say when they see this, they'll be like, "Well, why are you drawing your trend lines there?" Or technical analysis is not reliable because you can see the trend lines don't work, but they do. They're giving us, again, these trend lines. We're not connecting dots on a chart. They represent human thought and sentiment, right? And what people think about Ford. And overall, people have not been excited about Ford for a while, right? Now, there have been an occasional attempt at breaks, but they eventually fail and come back in. But overall, they give us a good idea of what the sentiment is and where Ford is going. Now, I was looking at this, and earlier in the week, I was thinking to myself, well, we're rallying, but I still think there's significant resistance overhead in the markets, and I think that overall, we probably will find some more selling pressure before we break to new highs, right? So I was looking for names that were bouncing into resistance that could give us potential short trades, and I think Ford is one. Now, that being said, if we do rally, and if Ford has some work to do, but if Ford could break 245 or so on the weekly, then that's a big move upwards, and the potential break of this downtrend. Even though it's tried before and failed, you still have to respect the breakouts until they fail again, right? Now, if we go back to the daily chart and we look at the $10 level, which is what you're looking at, we see a potential bullish play here, right? And I know this is what you're looking at, is we have a potential here for a bullish move off of what should be a bearish pattern, right? And why I say that's a bearish pattern is we had this nice base, we broke below it, we came up and retested it, and we have an ascending triangle, which a lot of people will say is supposed to be bullish, but in reality, this is kind of like a bear flag, where we're just kind of consolidating and trading and trying to breach 10 and not doing a good job of it. So if this fails, then we have a move that's going to lead right back down to 9 and change, and possibly all the way down to $9. If it can break above it, though, then we have a false pattern, right? We have a pattern that was supposed to be bearish, which breaks to the upside. And a lot of times, that's how you get your strongest moves, is off of plays like this, at which point you can expect to move upwards and back up to about 1050, at which point you see these two major levels that it needs to break. It needs to break this descending trend line, which is a long-term trend line, and then we need to break this 1050, which was kind of a key area as far as a long-term price action is concerned as well, right? So in my mind, this thing needs a lot of work in order to have a real strong breakout. And you might not have seen that if you were just looking at the daily chart, right? If you're looking at the daily chart, then these two trend lines don't never materialize. And all you're looking at is, well, we had a nice gap up, and then we kind of came back and filled the gap. But if we can break past 10, then we should break 1050 and continue upwards. And that might or might not happen. But you'll notice there is going to be significant resistance as it makes its way back up to 1050, and you'll understand why it failed the first time it tried to breach that level, right? So my advice to you on this is, if it breaks 10, trade it to the long side, right? Because in the short term, momentum is up, and it's building up, trying to break past that. But understand that there's a good chance it might fail around 1050, and if you see a failure around that point, then you could turn around and short it. And again, if it breaks to the downside here, then I think, again, we could look at it, particularly if we see a breakdown in the markets and we see the markets start to trace a little bit lower. So some of it's going to depend on what the markets are doing. If the markets continue to sort of trade sideways and print a kind of a bull flag scenario, then there's a good chance that this is going to try to break out and push towards 1050, at which point, again, I think that's the major area. If it can get here, then I think we might be seeing a pretty big shift in character in Ford and a major bottom, at which point this could be a name that trades to the long side for a while. But if it can't get above that area and it starts to hover around here again, then you can start to look at it as a short once it starts to lose the top of that channel again, at which point you can look at it start to move back down. So that's my thoughts. Interesting that you asked the question on one that I already kind of paid attention to, so it made it a little bit easier for me to point out a lot of the levels that I've been watching on it and what I'm looking for in the short to intermediate term. So hope that helps, Wes. Thank you guys, those of you that have stuck around. I appreciate the attendance. I appreciate the participation. Hope you guys are having a good time with this market. I know it hasn't been the easiest, but it hasn't been that rough compared to what we saw at the end of last year. So hopefully you guys are doing okay with it. If you have any questions from here to next Wednesday, you can always catch me on Discord. You can email me. You can ask me on Twitter. If not, have a good rest of this week and weekend, and we will see each other again next Wednesday. Thank you, Denise. You too.